now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Fed Day and Inflation Day, actually. So it's Wednesday. This morning, of course, is the inflation print. Everybody's, waited with bated breath about what's the inflation number going to be. Is it going to be hot? Is it going to be cold? What's this mean to the markets? We'll talk about that in a second. But yeah, so inflation this morning, of course, the Fed already has this data. They're in their two-day meeting. This afternoon will be the Fed decision. Expectations are right now that the dot plot, right? So this is one of the quarterly meetings where they issue out their dot plot and their economic projections. And what we're expecting to see is that for the end of this year, that the number of expected rate cuts will probably drop from 3 to 2. Which is kind of in line with the fact that we've just gone kind of into this year. We were going into this year with 3 rate cuts. Now we're halfway through the year, so it's just simply running out of time to cut rates, really more than anything else. And as we've talked about before, the Fed and again, there's no guarantee of this, obviously. It all has to do with economic data. If we have a very sharp downturn in economic data, it's not going to matter. They're going to cut rates. But they're probably, assuming everything remains kind of status quo right now, probably not going to cut rates either in July or September in order to not really be seen as affecting the outcome of the election. So we'll see. So if you take out those 2 meetings, that only leaves 2 meetings, November and December, to cut rates. So again, this is kind of where things are stacking up at the moment. Again, none of this is guaranteed. We'll see how this stuff works out. But today's meeting will give us a fairly big clue. Again, don't expect much of a change in terms of the narrative of what the Fed's been saying as of late, that inflation's remain a little bit stickier. They're reticent to cut rates right now, but there's no rate hikes on the table. So nobody's talking about hiking rates at this point. The overarching theme is that the economy is slowing down and they will cut rates. The only question is when. The other outside event of this is also quantitative tightening. Expectations are right now that they will begin reducing the rate of the runoff of their balance sheet in July. So that theoretically provides some liquidity back to the markets. Now, again, we've talked about this before, but a quick reminder, quantitative tightening is not selling bonds. They're not selling bonds outright in the open market. That was a big, issue. People were saying, oh, the Fed's selling bonds. It's going to cause rates to go to the moon, etc. No, that's not what's happening. All they're doing is every month, because they have a lot of bills that they own on their balance sheet, every month when bills come due, they just don't replace those. So, for instance, if the runoff is $65 billion a month and they have $100 billion worth of maturities, they're actually buying $35 billion worth of treasuries to make up the spread between the 65, the 90, whatever the number is, and 100, right? So they're just letting bonds mature and roll off their balance sheet. They're not actively selling. So that's why interest rates have remained kind of range bound despite all the other things that are going on in the overall market, because they're not actively dumping treasuries. When they start reducing that runoff, right? So if they go from 90 to 65 to 35 as an example, and they get down to 35 billion, now all of a sudden they may have to start buying bonds out of the markets. In other words, effectively QE, and this provides some liquidity back into the marketplace. So we'll see. But again, these are just kind of some of the dynamics that are running through the overall markets. So QT really kind of on the table for July. Keep a watch out for that today. I don't expect any change there. The other side of that is going to be when really just kind of looking at when those rate cuts are going to come. Markets are going to be looking for rate cuts to come maybe in July. May see some disappointment there. I think we might see those kicked out. Again, I don't know, but we may see those kicked out a little bit further because of the election. It's just 4 months away. So we're getting fairly close to the election right now. Inflation print this morning is expected to come in a little bit softer, both on core and headline. A lot of that have to do with just simply we've had a fairly big drop in energy prices. We talked about yesterday. You had a fairly sharp drop in energy prices over the last month or so. That'll get reflected short term just into lower input costs. Again, not a huge component. The big driver, of course, is rent. So everybody's going to be looking at that. Homeowners equivalent rent expected to also come down here a bit from the last month. So, if that feeds in, we could see a inline to a slightly weaker than expected CPI print today. Markets may already know this because the markets rallied yesterday to an all-time high, probably on expectation of this little bit weaker print, which will keep the Fed on track to cut rates. Speaking of the rally yesterday, here's what you need to know before the bell. So markets did set an all-time high yesterday. Again, marginal new high. Headlines yesterday, markets hit an all-time high, right? It sounds like this big move yesterday. Yes, the markets actually traded negative for most of the morning, wound up rallying into the afternoon and into the close. Now, that's good news, by the way, because we're seeing institutions coming in, buying into the marketplace in late afternoon trades. So that's giving this bull market some credence here that we're getting some institutional buying. But we did actually set a marginal new high yesterday. Again, nothing dramatic here. Still really, yes, we're moving higher. We're tracking right along that 20-day moving average, again, just as we kind of did back in January, February, March, kind of rebuilding that same pattern. Rally a bit, retest the 20-day, rally a bit, retest the 20-day. This is likely the scenario right now that we'll continue on. Markets just kind of really just remaining in this fairly consolidated range. Yes, we're making a new high here, but not marginally by much. We're a little bit higher than we were, back in early May. But again, gains have been somewhat moderate here over the last month or so. The big driver yesterday, of course, was Apple. And Apple had a very, very sharp move yesterday on their advent of Apple Intelligence. So not artificial intelligence. This is now Apple Intelligence. And the one thing you have to give to Apple, look, you may or may not like Apple, and that's okay. I'm not a huge fan of I don't use their products, but we own it. But I don't like their products, right? I'm just not an Apple guy. So one thing you have to give them, though, is that they are marketing geniuses. And while everybody else is running around going, oh, we've got artificial intelligence, Apple comes to the table and says, you know what we've got? We've got Apple Intelligence. So, give the marketing team kudos where they are due, because they are definitely due there. One thing here is that Apple has been trading in a very big trading range now, really going all the way back to July of last year. We have just traded sideways now. Apple really has not been contributing to the Mag 7 as much as they weren't pulling their weight, right? NVIDIA was dragging up the Magnificent 7 for sure. Apple's now back in the game. Big breakout of this big consolidation for the market for Apple. Apple traded there for over a year. From July of last year, June of this year, finally broke out of that range. So this is going to start to pull, that technical breakout is going to start to pull traders back into the stock now, because there's now momentum behind the stock. It is overbought here short term, so expect a bit of a correction. What you're looking for is a correction back to this $200 level, which is across these previous tops. This has been a big range that was running between 200 and about 180. We broke out of that range, so look for a bit of a pullback here. Look, the market's going to have a correction here at some point. Apple pulls back, retests 200, holds that support. That'll be your entry point to add Apple to the portfolio. So again, big driver yesterday, such a big weight in the overall index. That's why it pulled the whole index higher yesterday. But Apple Intelligence now driving the market, at least for the moment. That's what you need to know before the bell. We'll come back after the break and talk a bit about the market outlook here, where we're going to go. Danny's got some interesting topics to get into this morning, but one thing in particular, market forecast. A lot of these big macro forecasts that we've talked about previously, and we've warned you about, be careful with these big macro forecasts, is that they often don't come to fruition in the time manner that you think they will. We'll talk about those a little bit more this morning. Don't go away. More of the Real Investment Show coming back right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So I've got a question in our chat I wanted to address here real quick because it's one of our clients. So you take priority, right? Well, I don't care what we're going to talk about on the show. If you got a question, you're a client, you get the priority. Question is about owning individual bonds versus bond ETFs. And I just actually had this conversation yesterday with one of our other clients. We had a conference call. It's one of our high net worth clients. And they own a lot of bonds. And so the question was about the outlook for bonds and, market, expected rates of market returns, those type of things. So first thing is very important to understand is that, and I've said this before, is that when you own fixed income, it is part of the risk profile management of the portfolio. So if you're looking for market-based rates of return, you don't want bonds in your portfolio because that's going to drag. But what bonds do is they provide a hedge during downturns. So when things get really ugly in the market, so if you're expecting a 50% drawdown in the market, 40% drawdown in the market, whatever it is, you want to own treasuries. Now we're talking specifically about treasuries here. We're not talking about corporates. We're not talking about munis. Those all have, bonds, just like stocks, have all different types of characteristics. So we're going to keep the conversation real simple. We're just going to talk about treasuries, long duration treasuries at the moment, because the reference was a treasury bond versus TLT or EDV. So if your portfolio is a 60-40 allocation, and just using this as a kind of a base model, right? So with a 60-40 allocation, you can pretty much model out what your expected rate of return is going to be, assuming bonds do nothing, right? Just bonds hold a flat rate in terms of price. They don't go up, they don't go down for a year, as an example. So you can model out your return. My expected rate of return is going to be 4.5% from the Treasury. So there's 40% of 4.5%. I've added about 1.8%-ish rate of return for my portfolio. Day one, as soon as I walk in the door, January the 1st, I already know I've got 1.8% for the market, for my return this year locked up just in treasuries. Now I just have to tack on what my expected rate of return from stocks are going to be. So I've got 60% of stocks, and let's just assume a 10% rate of return for the year. So 60% of 10 is 6%. So I can model out very, very quickly that I should get about a 7.8% rate of return this year in my portfolio. My hurdle rate which Danny talks about a lot, is 4%. So I'm 3.8% above my hurdle rate. So I'm in good shape, right? I don't have to worry about too much. If the market does take an entire drop, money will move to Treasuries in terms of safety, because why? Treasury bonds. Now, this is the important differentiator. Treasury bonds are highly liquid. I can sell them immediately, right? They have almost immediate settlement on the open market. So they're highly liquid. I don't have to worry about default risk. I don't have to worry about credit risk. I don't have to worry about anything, right? Because they're government guaranteed a payment. So if that's why in an event where there are a lot of uncertainty crops up during a market downturn, a significant one. Now, I'm not talking about a market correction. I'm talking about a recessionary market drag, that type of thing. Stocks will be down 30%. But I don't know what the outlook is for survivability of companies, right? Are we going to have, because it's a recession, are we going to have a lot of bankruptcies, et cetera? So corporate bonds typically go down in price, up in yield, because of the uncertainty of the economic outlook, right? Municipal bonds also have trouble with that because we don't know what the outlook is for corporate tax, for municipal tax revenues during an economic downturn / recession. So other types of bonds typically go down in price, up in yield during an economic recession. Treasuries typically go up in price, down in yield because it's safety and it's highly liquid. So the reason you own, in this case, the reason that you own an individual bond versus an ETF is because A, it is highly liquid. B, if you wind up, and let's just say interest rates stay exactly where they are for the next 10 years. They don't go up, they don't go down. In 10 years, you've got a set rate of return on your money, and the bond matures at whatever the maturity date of that bond is. An ETF doesn't mature. There's no price maturity on an ETF. So an ETF is more of a trading vehicle for expectations of where interest rates will be over a course of time. It's almost like owning a stock. Yes, you do have an underlying basket of bonds in that ETF, but they don't mature. They mature inside the ETF, but they're replaced. The ETF never actually matures. So ETFs are more of a trading vehicle, or for accounts that are too small to buy enough of Treasury bonds to really make it worthwhile. Excuse me. But that's kind of the overall scenario. So again, if you're wanting more return, right, you want to own less bonds. If you want more safety, you want to own more bonds, and particularly in this case, in the Treasury front.
Yeah, I think that's some good points. So the ETFs do go on in perpetuity, so they always have something rolling off. So take TLT, for instance. It has 44 different positions. So instead of owning the individual bond, you own the position that has 44 of these. Now, if rates are declining, you're going to have, we look at the duration. That's going to be the measure of sensitivity to interest rates. And that's going to give us the expectation of what we could see from a price appreciation standpoint when yields drop. So if we look at duration, it's a measure of sensitivity to a rate change by 1%. So for instance, effective duration on TLT, 16.53%. You could expect, if rates were to drop by 1%, a 16% increase. Now, if you own that individual bond, you can also expect a similar type of increase if we saw a rate decline of 1%. However, your yield is locked in versus on that ETF, as something is always maturing, they're going to have to go out and buy another long duration bond at lower interest rates. And so in an environment where we're seeing yields potentially drop, I think we're getting closer. We'll find out a little bit more today from the Fed. The individual position could be to your benefit if you're going to hold it for a period of time. This is where I think it's going to be an interesting kind of, people are going to be stuck between a rock and a hard place, Lance, in the sense that at what point do you take your chips off the table? Mm-hmm. Right? Because now you've got the appreciation. Yields have dropped substantially. You're going to really like that yield. And that's going to be tough for a lot of people, I think. Right. It's in the individual bond, somebody mentioned this in the chat as well. The individual bond is something that I know people that bought bonds years ago, decades ago, and they don't care where the price is. They're in it for the income. So you can extract some predictability out of it, mm-hmm. in a sense of, we know if we need to set some income, we can derive that from that position and know exactly what you're going to receive with that individual bond. Whereas on an ETF or even a fund, there's not that same predictability. So we need to understand that the differences here is there's a handful of moving parts. I mean, for the most part, they're relatively very similar, but if we want to lock in a yield, the individual bond is going to be to your benefit.
Right. And again, this is just, again, it's how you choose to manage your own portfolio. And again, it's not for everybody, but again, this is just how we manage money. So we calculate risk and return, and we look at hurdle rates, and we build portfolios to build around that. And for us, Treasury bonds are a risk hedge more than anything else. Look, we know what the long-term rate of inflation is going to be. We know that and we can model that. You can model inflation rates out. In fact, I've got an article coming out on Friday talking about James Grant of the Interest Rate Observer. He recently made the statement about why inflation is going to go up and interest rates are going to go much, much higher for longer. And his whole premise is that, well, it's because interest rates were low for so long, now they've got to go up. And that's kind of like saying the Atlanta Falcons have never won a Super Bowl for the last 58 years. So now they're going to win the Super Bowl every year for the next 58 years simply because they haven't won it in such a long time. And that's just a false narrative because that's not how things actually work. What we do know is that inflation and interest rates and GDP, economic growth, and wages are all very closely correlated and tied together. Demographics, debt, all that type of stuff drives to lower rates of economic growth, lower rates of inflation, and ultimately lower interest rates because those have to correspond with each other because, as we've talked about before, interest rates are a function of credit risk, default risk, opportunity risk, growth risk, those type of things. So because, again, if I'm loaning money to somebody, if I'm going to loan money to Danny says, hey, I want to borrow $100,000 from you. Great, no problem. I'm going to look at it. I'm going to look at his credit score, make sure he can pay me back, right? I'm going to look at the opportunity risk that's out there. I'm going to look at what he's investing the money in. So he's going to borrow money from me to start a business doing something. I'm going to go, well, that business...
Basket weaving degree.
Yeah, basket weaving is probably going to default. So what's my default risk in that? Because what my interest rate has to calculate is what is my return on that loan. I'm going to give him money for 10 years. I've got to capitalize. For 10 years, I won't be able to do anything with that money because I'm just going to collect that set interest payment for 10 years. That's all I'm going to get. So if every other investment in the world is paying a higher rate, stocks, commodities, whatever it is, I'm going to invest in that rather than loan him money. So I've got to make sure that there's a return there, a rate of return relative to that. So if the economy is slowing down and demand for credit is slowing down, that is going to lead to lower interest rates. And that's just a function of math. So we can look forward as to where we are with debt, demographics, deficits, all that. That all leads to lower rates of economic prosperity, ultimately lower rates of economic growth. Lower economic growth, lower inflation, lower interest rates. So if I can capture 4.5% now for 10 years, I'm going to be in a much better position in 5 years. So these are long-term outlooks. And in 3-4 years, if inflation's back to 2%, my 4.5% yield is going to look pretty good to an investor that wants to buy it from me at a very nice premium.
Yeah, keep in mind, they're just IOUs. And so, I see on the chat, everybody's talking about corporate bonds. The difference, you kind of mentioned that right now. You prefer treasuries over corporates. I think anything at the moment, especially, we're going to talk about forecasts. We can talk a little bit about that more on the other side of this. But it's going to be very important on what you choose and how you invest, especially in that fixed income space.
Yeah. Apple, they've got Apple Intelligence. We'll just ask them.
There you go.
Yeah.
Somebody said an apple a day keeps inflation away.
Yep. I don't know about that, but they've got Apple Intelligence.
As of yesterday,
they're going to cure everything. So, all right, quick break. We'll be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will
video go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny, you know inflation's getting bad. You remember back in the day when strippers used to have names like Crystal and Diamond after something really expensive?
No.
The Real Investment Show podcast.
Well, now you go to the men's club, it's like, welcome to the stage, gas and eggs. So, I mean, you just know stuff's getting bad, man. Inflation.
Same show, your schedule.
Where'd you get this from, Lance? Is this?
I was thinking about this last night. I was like,
at realinvestmentadvice.com.
because it's an all-cash business.
Yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right. Let's talk about forecasting here a bit because this is always very interesting. Headline in the Wall Street Journal: the world will be swimming in excess oil by 2030. Now, again, it's always interesting when you see these headlines like this because, Danny, do you remember the headlines in 2007?
The world was coming to an end, or actually, no, then everything was great.
Everything's great. Everything's great, wonderful, but oil is running out. We have reached peak oil.
$147 a barrel, I think, or what, 151?
No. We got there very briefly, but predictions were for $300 a barrel.
Yeah.
And peak oil had come, and of course, there was no solution for this. We're just simply, the world is running out of oil. And then, of course, we go through the financial crisis, and as is always the case, when there's a shortage of something or too much of something, people come up with innovative solutions, and we learned how to frack. And so we had this fracking miracle that evolved in 2008, and now we became, and by the Trump administration, we had now become I got this hat, by the way. Who'd this come from? I don't know, it showed up. We had a hat one day just show up. But so by the end of 2008, we had developed all this fracking technology, and by the Trump administration, we were actually a positive net surplus of exporting oil. So and now the worm has turned, and now we're back to now we're going to be just swimming in oil. by 2030. So again, the problem with these long-range forecasts is, and betting on them, there was another good one out this morning. Lately, uranium has been the big driver, right? Uranium price has been going up because we've got to develop all these nuclear power plants, et cetera. And it's a great narrative, right? The problem is it takes a very, very long time to build nuclear power plants because of permitting and construction and all this. And you don't need uranium until the very end of the project. So the price of uranium has gotten way ahead of the actual production of nuclear facilities. There was a report out this morning talking about nuclear power. It's not expected to really come online in magnitude until 2050. So, you've got 25 years of development time to bring these nuclear power plants. Now, will there be a need for more uranium? Absolutely, right? Uranium is not a rare substance. It's everywhere, right? And so we can get it, but we just don't need it right now. So uranium prices are getting very far ahead of the actual need or the actual demand for developing nuclear power. So investors tend to get ahead of these things and then make bets on something that's a long-term outlook that can change over time. And by the time we get to 2050, who knows? We might be into some other type of power generation, and we'd say, we don't really need nuclear. We're going to do everything by, splitting the hydrogen atom, whatever it is. Things change. And that's the important thing about investing is these long-term themes and long-term outlooks are fantastic. Just be careful to understand that things do change over time. And again, this is, one of the most famous predictors is Harry Dent, who correctly predicted the crash in 2000, right? And of course, that's really where he kind of made his name. And Dan, you remember that whole, outlook for Harry Dent. And then, of course, since then, it's been kind of an ongoing saga of predictions. And how's his predictions been turning out?
Well, they haven't been so hot. And, that's the problem, right? I think that he's burned himself. And so, he has a best-selling book, The Roaring 2000s, Building the Wealth and Lifestyle You Desire in the Greatest Boom in History. Mm-hmm. So he predicted.
And that was back in the 90s. He wrote that book.
This was in 99 when it was published. Yeah. So it was interesting that he called basically the dot-com bubble. But yet he believed that this was going to be the greatest decade that we've ever seen. Mm-hmm. In fact, so much so that he thought we would see the Dow hit 35,000 by the end of the decade. And if you go back to 2000 all the way to 2010, so keep that decade in mind, they consider that the lost decade. I mean, you had times of prosperity. You had, 01, 02, 03, down markets. You had, 4, 5, 6, 7 good markets, right? And then 8 just wiped it. Clean the slate. And then we got back to some decent markets, but you actually didn't make any money during that full decade. So people ask well, you guys are really conservative in a financial plan. That's the reason. That's one of the big reasons, is that there are times in history that the markets will be down for prolonged periods of time. And we want to make sure that our clients can meet and still, meet their expectations or exceed them and not have to go back to work, not have to worry about, all the other things that come along with this. And so he was way wrong right after that.
Yeah.
And I think that, sometimes I think people get stuck, and maybe he got so wrong that he's just, the sky is always falling. He always says at some point, I'm going to turn bullish again.
Yeah.
I've not seen that time yet.
Right. Well, this is the case for most of these outlooks. And this is why, we always caution you here on the show, be careful of these more extreme outlooks, right? The world's going to crash. We're going to de-dollarize. We're going to, and we were writing a lot of articles last year because the whole de-dollarization issue, which, the dollar's been rallying since. Be careful of these big major macro outlooks because, again, the big issue is that things change. The one thing about the United States historically is that we're very adaptable. So when something happens, we typically respond with some type of solution. And so the most dire outcome generally never occurs. And it's kind of like everything else. You get some bad news. You go to the doctor, right? And the doctor says, there's this spot on you. Just going to run a test on it, and we'll see how this goes. You don't have the results right away. You go home, and then for the next 3 days, while you're waiting for the results, you imagine you do the worst thing ever. You go research it on WebMD, and now you're completely convinced that you've got stage 4 cancer of something, and then you find out, it's completely benign. It's just a mole. It's fine. But this is how we react as human beings. We always expect the worst possible outcome, and we imagine what the worst possible outcome can be. But the reality is that very rarely happens. We talked about on the show before about the bell curve of outcomes. And yes, another financial crisis is is certainly on the bell curve, right? But it's out there on that tail. It's about a 0.014% chance that will happen next week or next month or next year. The more realistic outcomes is, yes, we could have a 20 to 30% drawdown. In fact, I'm doing some analysis right now for next Tuesday, I believe, looking at valuations, and that we've had a permanent shift higher in valuations because of economic growth, because of monetary influences, et cetera. We've permanently shifted valuations higher. So a valuation correction back to the median valuation require a 40% decline from here, assuming earnings and prices stay where they are right now. Well, 40% only gets you back to the peak of 2019, right? You haven't even violated the bullish trend from 2009. So again, we can talk about these more macro narrative events, but what does it actually mean for your money, for portfolios, those type of things in the near term? Which, as we talked about the other day, we've got to go make money today. That's our job, right? That's our job as portfolio managers. That's Danny's job as a portfolio manager. We've got to go make money for our clients today. We keep that. Yes, those long-term outlooks, we certainly keep a watch on. We certainly look at the data. We certainly understand what those risks are. But we'll wait for the evidence of those to start to show up before we start taking real drastic actions. The problem with taking drastic actions today is you wind up with such severe underperformance over time that you might as well have just gone through whatever the event was. You'd be about the same at the end of the day. So, just kind of, just always keep these big macro views somewhat, nothing wrong with them, right? Whether it's Harry Dent or whether it's, whoever, nothing wrong with learning about them and understanding them and what the causes are. Just don't let them drive your trading and your investing in the short term, because those things very rarely come to fruition.
Well, it's interesting that he is probably one of the most widely followed prognosticators. Mm-hmm. And, right after that he claimed this was going to be the biggest boom, he doubled down. He said the next great bubble boom had a profit from the greatest boom in history from 2006 to 2010. And smack dab in the middle of it, you get 08. So, you've got to be cautious with this overall big narrative, and especially somebody like this. And I understand that it's so much easier to follow something like this because, oh, man, and we can make a pros and cons list, and that cons list is usually way bigger than the pros.
Yep.
But it doesn't always happen. There's times like we look back and we think about 2020, and I guarantee you if you and I would have sat here on the show and made a list, and you guys in the YouTube chat, if you would have tagged onto the list, we would have said, okay, if we would have wrote down everything that happened at the end of the year, before the year started, you'd have been like, you guys are nuts. So this does happen from time to time.
Yep.
But for the most part, these things don't come to fruition as often as many people believe. Right. And then we get caught up in our own kind of tailspin here of this belief system. And unfortunately, many people don't change from it. You double down, or you just say, we're going to wait it out. And we end up waiting for too long. I mean, how many people do you know that never got back in the market after 08 because of people like, Harry Dent afterwards, like, oh my gosh, the sky is falling. And that's always a kind of a continuation. And so that's where you do have to be cautious. So Lance, got some questions actually after your newsletter this weekend in the sense of, okay, we're hanging tight. Market may be a little bit overdone here.
Right.
What is the move? How come we're not making major moves to the portfolio from taking more chips off the table?
Because it's still going up.
I was hoping you'd elaborate maybe just a tad bit.
Well, I mean, we're on a break, so
yeah, I know.
We'll go back. We'll talk about that, and also why cell phone usage is dropping, and what do hot dogs have to do with anything? That's all coming up next.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So Larry in our chat has the cure for cancer. Basically, just don't eat. So, yeah, that'll cure you cancer as you starve to death. So, you know, it just depends on how you want to cure it, right? So, just for the break, Danny, you were talking about, you know, why we're not taking more chips off the table right now. We're also not adding a lot of exposure to the portfolio right now, except for small little trading positions here and there. Like we increased our energy exposure yesterday because oil prices have turned back up on a buy signal, and they got and commodity longs on oil have gotten pretty vacant at this moment. So there's not a lot of people long oil, which kind of sets up for a bit of a short-term rally. But there's also no reason to take a lot of money off the table right now. There's certainly some concerning signs. Like, if you take a look at relative strength, you take a look at MACD indicators, et cetera, there's a negative divergence there. Breadth is obviously very narrow in the markets right now. So there's certainly some concerns that will lead to an eventual downturn. But just like we were back in January and February and March, in February and March, we were reducing equity. You know, we sold, some of our position in NVIDIA. We reduced our position in Apple. We reduced our position in AMD because we were expecting that downturn to occur. We're talking about a 5 to 10% correction was coming in the very short term. We got that in April. And then in April, we started buying back share. We added back to Apple. We added back to NVIDIA. We added back to AMD, et cetera, during that downturn. So again, that's just, the portfolio risk management. And right now there's no reason to take money off the table because markets are breaking out to all-time highs. The bullish trend is very much in place. If we get a weak inflation report this morning or a more dovish Fed, the market's going to go higher. So again, we don't want to trail our performance mark too much. But again, once we start to see the technicals break down in the markets, we'll start reducing equity exposure again. And if we start breaking important levels of market technicals, we'll drastically reduce our equity exposure when we get there. So again, that's why.
Yeah. Now, what about volume right now? Volume appears to be a tad bit lighter. Is that just seasonality?
Partly seasonality. We're heading into summer, but it's also just the fact that most people that have bought.
Yeah.
So
now, couldn't you make that argument that since the markets are hitting all-time highs, that exposure reduction would be prudent?
No.
Okay.
All-time highs beget all-time highs.
Yeah.
Right? So, I mean, if you go back and look at any period where the market's hitting all-time highs, it typically continues to hit all-time highs because you have momentum, right? So the problem with reducing exposure too much when you have a momentum run going on, which you have going on right now, that you're going to wind up lagging performance. And then you're going to complain to me because your clients are complaining to you why we don't have more equity exposure because markets are going up.
Yeah, no, and I'm asking these questions because these are things that we do get commonly.
Sure.
And so I think it is important to keep that in perspective. But the other caveat is, like you mentioned, we've reduced exposure along the way and reallocated to other areas, kind of a sector rotation to some extent.
Right, but basically what you're talking about, though, is very important because that's the psychology, right? Markets are going up. Oh, man, markets are all-time highs, so that means we're going to crash. And so, I need to get out of the market. Then the market keeps going up more, and you go, well, I'm not making as much money as the market. Now I got to get back in, and that's typically when you buy right at the peak of the market before it corrects. And it's the same thing as last year, right? We reduced exposure in May of last year, too early, right? May, June, and we're talking about a 10% correction last year.
Didn't happen until what, September or October?
No. It started in July, and we corrected 10% in August, September, and bottomed in October, but we were down 10%. Well, in July, everybody's super bullish about the markets, and we were getting calls from clients going, I need more exposure. This market's just going up. It's all about AI. Why don't we have more AI in our portfolio? By October, everybody's like, why aren't we just getting out? The market's just going to go down now. I mean, it's not.
The psychology of it was crazy last fall.
Exactly. And that's the problem with what you're talking about. And this is why you manage risk by making small moves, not big moves. You win football games, by moving a ball inches, not trying to score a touchdown every play. You win a baseball game by hitting singles and doubles, not trying to hit home runs. That's the same thing with portfolio management. Small moves make the biggest difference over time, not making big macro changes.
Yeah, and I think that's
based on psychology, right?
Correct.
I'm just worried that the market's going to go down because we're at all-time highs.
Yeah.
Right.
Well, and I think, though, that people do see the writing on the wall, right? We're getting some revisions to retail sales. We've seen the jobs number, albeit the headline looks really good. You peel back the layer and you're like, whoa, okay. We start to say, part-time jobs are greater than full-time jobs. There are some things to be concerned about, but yet these are all things that the market is taking in stride. It doesn't seem like there's not a whole lot to throw the market off at the moment. I mean, we've seen Treasury yields, they've popped, 30 basis points and dropped 30 basis points in a 2-3 week time frame?
Yeah.
Yeah.
And that's just part of the market. So Joey Chestnut, do you know who he is?
Oh, I know who he is.
I know.
Yeah. So Joey Chestnut, the world record holder for how many hot dogs you can eat in a minute. Not a minute, 10 minutes. I had to look that up.
Yeah,
That's amazing.
76 hot dogs in 10 minutes.
Yeah, I can eat 7 hot dogs in 10 minutes. Which is amazing. So Joey Chestnut, if you guys don't know, you can actually, I think you can turn on ESPN and you can see it every 4th of July. The hot dog eating contest at Coney Island. Rich is there each and every year. He's a judge for the contest. But so he's actually been banned from it because now he has endorsed a vegetarian or vegan hot dog. So the professional hot dog eating world is up in arms. As Joey Chestnut said, he's gutted that he's not allowed to participate. Right. They said he could come back if he actually didn't
endorse. Well, so Nathan's Hot Dogs is the one that puts on. They're the ones that sponsor the hot dog eating contest, and as part of the MLE, which is the Major League Eating Organization, as opposed to MLB.
Which is crazy.
So again, Nathan's is sponsoring this, and so now Joey Chestnut went and signed this contract with a vegan hot dog producer, which I don't know why you would even do that, but if you're gonna eat a hot dog, just eat a hot dog. But anyway, but now, of course he did it for the money, but he was offered $1.2 million.
Yeah,
for a contract, for a 4-year contract to come compete at this hot dog eating contest, which he's won, I believe, 16 years in a row that he's won this contest. So they were going to offer him a 4-year contract for $1.2 million. Apparently, the vegan hot dog company paid him more, but now he's not going to be able to compete. So if you're a big Joey Chestnut fan, he won't be at the MLE hot dog eating contest in July.
Oh, he may. They said he could come back, but it's always funny. I had a guy I used to work with who loved Joey Chestnut in this contest. So I texted him and said, hey, man, you're going to be okay this 4th of July, because he's not going to know what to do with himself. I think it's a family tradition that they grill, put some burgers and hot dogs on the grill and then watch. But, going to have to make a change, I guess. I've maybe watched it once.
Maybe. But interestingly enough, hot dogs. So Nathan's, of course, you can buy Nathan's hot dogs at the store, and they're famous for their hot dogs out of Coney Island, New York. But hot dog sales have been on the decline over in recent years because people are getting more health conscious and trying to eat a little bit better. Now we have this whole advent of GLP-1s, which is the semaglutides, which help you lose weight. Of course, this has been the rage in the stock market lately of Eli Lilly. Interesting study out, by the way. Just came out. They found out that people that get on GLP-1s, of course, when you get onto a semaglutide, it makes you nauseous. So you really just don't want to eat. And when you think about eating food, it just makes you kind of sick to your stomach. So it's the way it works is reducing your appetite so you don't eat as much. And so, people that are used to eating a lot of fast food or a lot of junk food, et cetera, those cravings are still there, right? The semaglutide does not affect that craving. So it's still there. And what they're finding out is that people will go into the semaglutide for one cycle, which is about 12 weeks. And then they come off of it. And of course, the problem with any diet, people diet all the time. And the reason diets fell is because you never change your behavior. And when you don't change your behavior, as soon as you come off the semaglutide, your appetite comes back, and so does the weight and everything else. So, and so what they've got to figure out is how to maybe reduce some of the side effects so people can will stay on the treatment longer.
You mean they have to create another drug for the drug?
Maybe, but however it is. But again, it's a very interesting, and it's not surprising, right? And so this is going to have some implications potentially for Eli Lilly, for Novartis and others that create these semaglutides, because again, what the whole projection ramp was on earnings is that people were basically half the entire country was going to get on semaglutides and stay on them. And that was going to drive this massive ramp up in terms of these obesity drugs, in terms of revenue. And people would be healthier, they would lose weight, we'd have less diabetes, which would help fuel more cells. But apparently that's not the case. So we'll see. But it's just interesting. And again, this whole semaglutide thing is a very early, drug release, and now companies like Hims that provide over-the-counter treatments online, like Viagra or hair treatments, et cetera, they're now looking at being able to provide semaglutides online. So basically, just go online to Hims or Hers. They do both, Hims.com and Hers.com. Plug in your information, and they'll ship you a semaglutide treatment. So, we'll see how this works out. But we're long Eli Lilly stock. It's been great for us. But again, it'll be the question is the sustainability of the revenue growth.
Interesting. So I know tomorrow you and Mike are going to cover probably a lot about the Fed, right?
All of it, yeah.
Fed, interest rates, bonds. Will you guys cover? I've been getting some questions on commercial real estate and what the impact to banks will be in general.
None. Yeah, I talked about that. We'll talk about it some more tomorrow, but I talked about that recently. I went to that distressed debt conference in Milwaukee, and all the banks were there. And they are basically getting all the properties off their balance sheet. They're selling these things at 20 and 30 cents on the dollar, getting them off their balance sheets ahead of time. So, people expecting a commercial real estate financial crisis like we had back in 2008, it's not going to happen because the debt's getting off their books, and they're writing them off early.
Interesting.
All right, wraps up the show for the day. We will talk all about Fed inflation tomorrow with Michael Leibowitz, so tune in tomorrow. Have a great day. See you back in.